In today's video, we will look at some very lucrative passive income-making ETFs that may just be a dividend investor's dream, and we'll begin right now. A lot of investors simply love dividends, and I totally understand why, as a dividend snowball can be fantastic for your portfolio's growth. When you start to see reinvested dividends producing even more dividends, you can really set up the potential for some impressive returns. For the older investor, these dividends can also be a great way to supplement their lifestyle in retirement. You can be any age to enjoy the flow of some nice passive income. Before we jump into those ETFs, let me know in the comments if you are more of a dividend investor or perhaps a growth investor. I tend to fall 60-40 in favor of dividends. Also, a huge thank you for dropping in today, as together we make this the home of free financial content. So be sure to subscribe, as you do not want to miss a single moment. Last November, I dropped my first dividend ETF video, and here's the thing. In that video, the highest yield was 8.1%. I think we can do better than that. In fact, for today's ETFs, all 6 of these ETFs will have a yield higher than 8.1%. A lot of these ETFs were not available back then. Some of our major ETF management companies have started to offer much better yields via the power of covered calls. I did omit the 2 yield crypto ETFs from today's list simply because they are still adjusting yields as they navigate the bear market. So without any further ado, let's get this passive income powered list started. Our first ETF of the day is Evolve US Bank's Enhanced Yield Fund, which has a ticker of CALL or CALL. Their portfolio looks to replicate the Selective Equal Weight US Bank Index. In addition to that, they also write covered call options on up to 33% of their holdings to provide, well, those bigger dividends. They have a market cap of $29.6 million and a beta of 1.56, so these guys have a good amount of volatility. Their management expense ratio comes in at 0.45%. Their dividend yield comes in at 8.433%, and that is paid out monthly in the amount of 12.5 cents per share. Growth-wise, in 2021, we saw a return on investment of 30.16% as their share price rose from $15.98 to $20.80. Adding in the dividend, that is a 38.59% total return. So far this year, their share has dropped to $17.48 for a 18.99% drop. That growth in 2021 is absolutely deceptive, because when we zoom further out, we can see that growth was mostly them recovering from the big pandemic drop in March of 2020. Does that even matter? Honestly, probably not, because this is a dividend play, and if anything, bigger market swings down only make the yield more attractive and provide some better entry points. In position number 5, we have Harvest Healthcare Leaders Income ETF with a ticker of HHL. They are invested in large cap US healthcare companies with a 33% underlying covered call strategy to boost their passive income. They have a market cap of $1.04 billion and a beta of 0.83, which makes this ETF much less volatile than the market average. Their management expense ratio comes in at 0.99%, definitely a little high for sure. Their dividend yield comes in at 8.459%, and that is paid out monthly in the amount of 5.8 cents per share. Growth-wise, in 2021, we saw a return of investment of 17.45% as their share price rose from $7.62 to $8.95. Adding in their dividend, that's a 25.91% total return. So far this year, their share has dropped 8.22% down to $8.27. That is not too bad, and makes me think, of course, of that low beta. This is, well, once again, a total dividend play, as their growth was also recovery from March 2020. Nonetheless, a very solid dividend and a good source for passive income. And at number 4, we have another Harvest ETF, and it is the Harvest Diversified Monthly Income ETF with a ticker of HDIV. They are invested in 6 other Harvest ETFs for a much broader diversification. They also use covered calls to help generate more dividends. They have a market cap of $170.1 million and no beta score yet, because this is a brand new ETF that just began trading in February. They do not have a fixed fee, but any fees the underlying ETFs charge will be deducted from their overall earnings. Their dividend yield comes in at 9.32%, 0.26%, and that is paid out monthly in the amount of 7.1 cents per share. In terms of growth, we really are lacking data on that. They began selling shares in February at $10.07, and today we are at $9.11. So definitely they have dropped 10.54% in the bear market. Harvest is an overall ETF provider that has a solid track record, and this gives me a little faith that this ETF will do okay over time. Nonetheless, being new still warrants some extra attention. In at position number 3, we have the Hamilton Enhanced Multi-Sector Covered Call ETF with a ticker of HDIV. They are looking to replicate the Selective Multi-Sector Covered Call ETF index and multiply that return by 1.25 times using their own covered call strategies. They have a market cap of $220 million and no beta yet, as they are fairly new, having launched last year in July of 2021. Their management expense ratio comes in at 0.65%. As for their dividend yield, it is at 9.48%, and that is paid out monthly in the amount of 12.5 cents per share. In terms of growth, they launched with a share price of $16.37 and are currently listed at $16.33. They did peak at $18.86 just before the bear market began, so there could be some growth potential down the road. For now, this is simply a solid dividend player, and full disclosure, I have very recently added a few of their shares to my portfolio. Holy banana bread, we are already at number 2. And, well, we have the Evolve Canadian Banks and Lifecos Enhanced Yield Index Fund with a ticker of BANK. They are looking to replicate the Selective Canadian Core Financials Equal Weight Index and then pump up their returns using, well, covered call strategies. They have a market cap of $19.15 million and no beta yet, as they too are a new ETF having launched in February. Their management expense ratio comes in at 0.60%. Their dividend yield comes in at 10.345%, and that is paid out monthly in the amount of 7 cents per share. It does need to be said that this yield is inflated a wee bit due to their drop in the bear market. They launched with a share price of $10.05, and at the time of recording, they are selling at $8.12. That is a drop of 23.76%. They are recovering, but the point being that yield will come down as they do. This will more than likely settle into a nice little dividend payer. In all likelihood, if we were to do this video 6 months from now, they probably would fall a little in the rankings, though we could argue that with any yield stocks in the bear market. Always remember, if you buy an ETF with a yield of 10% in a bear market, you are still getting 10% on that purchase when their yield drops. But if you then bought more at, say, 9%, you would then be getting 9% on the new shares, but you still are getting 10% on the old shares. At our top spot, we have the Hamilton Enhanced US Covered Call ETF with a ticker of HYLD. This is a fund that creates a very nice monthly income by investing in a multi-sector portfolio of mostly covered call US ETFs. They have a market cap of $180.83 million, and once again, there's no beta with this one, as they did launch in February. Their management expense ratio comes in at 0.65%. Their dividend yield is fantastic at 12.23%, and that is paid out monthly in the amount of 14 cents per share. They launched with a share price of $16.08, and at the time of recording, they are selling at $14. That is a drop of 14.85%. They have begun to recover, but remember, like with all of these ETFs today, they are absolutely dividend plays. These are not ETFs for a growth-focused portfolio. I really do like this one, and I have a full 5% holding in my TFSA of this ETF. Despite that, they are new, and I will pay closer attention to them for sure. Right now, they are providing me with some very good passive income, and if that were to change, I have no issues rebalancing my portfolio. I really do like the diversification in this ETF. In my opinion, this may just be one you want to dive into research mode for. A little due diligence can go a long way. For sure. The fun does not have to end here, because you can always watch my video on inverse ETFs that I have linked in the top left corner, or right below that, YouTube will show you a video they think you will like. Your click will decide who is right, and I will see you in the next video.